Hello, I'm Bob Goulder, contributing editor with Tax Notes. Today, we're going to talk about a tax case of epic proportions, the Apple state aid case that's currently before the EU court system. More than 13 billion euros are at stake. And the case involves some very novel issues, both in terms of its substance and its procedural posture. To help us work through all these details, I'm joined by somebody who knows this litigation very well, our chief correspondent and my colleague, Stephanie Soong Johnston. Stephanie, thank you for joining us.
Hi, thanks for having me again.
Yes. The world is buzzing over this Apple decision. It surprised a lot of people. I think a lot of people thought the commission was going to win because maybe they had the home court advantage. They're the European Commission and it's before the European courts. But no, Apple won. And it wasn't even a split decision. I mean, they don't have to pay any taxes at all here. And I want you to describe basically, why did the European Commission bring this case in the first place? Because what's perplexing to so many people is that it's so different than the usual scenario where you have a government that conducts an audit and they deliver the corporate taxpayer with a statutory notice of deficiency and the taxpayer challenges it. That is not what is happening here with Apple and Ireland. The taxing government, Ireland, they want nothing to do with collecting these 13 billion euros, which is just crazy. That's not what we're accustomed to. Can you please explain the background here?
Sure. So in thinking about how to best answer the question, I was sort of thinking about what the situation was like, what the political climate was back then, just after the financial crisis. So at that time, after 2008, countries are still reeling from the fallout of the crisis and are working on economic recovery. And pretty soon, corporate tax avoidance starts creeping its way into media headlines. You saw in the UK, the media went really hard against Starbucks, for example, Google and other multinationals for not paying a lot of tax in the UK. And that was mostly a question of the tax rules and how they worked. And so there was a lot of attention about corporate tax avoidance at that time. So in September 2013, that's when the Commission announced it was going to conduct a broad inquiry into several EU member states' tax ruling practices to just determine whether there was formal state aid that was given to these companies. State aid is basically what state aid is under EU law is, when member states give a selective advantage to certain taxpayers that other taxpayers wouldn't be able to get access to. So that way it gives them an unfair advantage. So it's kind of a competition issue. So the Commission starts looking into these tax rulings, and then in June 2014 announces that it's going to go after Apple and will look into Apple's tax rulings that it received from Ireland. And at the same time, they also announced that they were going to investigate Fiat, which got tax rulings from Luxembourg, and Starbucks, which got tax rulings from the Netherlands. So then in November 2014, what happens? The Lux Leaks scandal happens. If you remember Luxembourg Leaks, the International Consortium of Investigative Journalists published its expose kind of exposing the tax rulings practices of Luxembourg through about 550 tax rulings that were leaked from PwC. So what does expose do? It showed the general public, hey, these are tax rulings. Companies are allowed to approach governments and get some assurance about what tax they owe in that jurisdiction. And by the way, isn't this shady? So this kind of lights a fire under the Commission, because at the same time, if you remember when Jean-Claude Juncker, he was actually president of the Commission from 2014. He was actually appointed just before the Lux Leaks investigation happened, was published, and it was kind of embarrassing because Luxembourg, he was the prime minister and the finance minister of Luxembourg at a time that these rulings were granted to these various multinationals. So, I don't know if there is like a direct connection between that and like what the commissions end up doing, but after this starts happening, the Commission starts really ramping up their investigations or state investigations into these multinationals. So particularly in Apple. So then in August 2016, the commission announced its conclusion that Ireland had given Apple legal state aid by granting two rulings in 1991 and 2007. These rulings had attributed the company's EU profits to the Irish branches of two Apple subsidiaries, Apple Sales International, ASI, and Apple Operations Europe, AOE, in a way that didn't reflect economic reality. And the commission argued that the sales that those companies recorded should have been attributed to the head offices that existed only on paper and weren't subject to tax anywhere according to Irish tax law. So ASI and AOE were wholly owned by the Apple Group, but were incorporated in Ireland and managed and controlled in the US. So that situation meant that neither country considered either company as a tax resident, so they were pretty much stateless. They had stateless status. And the tax rulings, the commission argues tax rulings artificially lowered Apple's tax liabilities in Ireland to a fraction of 1% by 2014. And then that gave the company an unfair tax advantage in breach of EU state aid rules. So then the commission demanded that Ireland recover 13 billion euros in back taxes from Apple. And I remember when this was actually announced, I was covering a tax conference in DC, and I looked at my phone and I was like, 13 million, that's not so bad. And I looked at 13 billion, oh my gosh, that's a lot of money. It was pretty shocking at the time. I think it shook up the tax world when that decision was announced. So Bob, do you remember where you were when this decision was announced?
I have no idea, but I don't remember where I was, but I remember taking your point that this sort of looks like an exercise in political responsiveness. You have a European public that is living under austerity and isn't happy about that, and they're getting less public services and paying more taxes, and yet they see corporations that are hugely profitable paying, what did you say, less than 1% effective tax rates or something like that. It varies from case to case, but there's a bit of outrage, and the outrage is understandable. And who comprises the European Commission? Well, they're politicians. So they feel they ultimately need to be responsive to their constituents. And that's really what's going on here. Now, let me ask you this. You mentioned Apple, you mentioned Starbucks. Those are both big U.S. companies. Fiat's not a U.S. company, but they do own Chrysler. Is there a anti-U.S. bias, perhaps subtle, but is that there in the selection of targets that the commission went after?
So, shortly after the Apple state aid decision was announced, Margareta Vestager, who was the EU's competition commissioner at the time, she went to Washington in September 2016 and had a press conference where she was asked this very question, like, are you targeting American companies? And she said, state aid investigations have been around for a long time. It is old school Europe. And they'd never deliberately targeted U.S. companies. And she said at the time that, out of the 150 decisions that led to state aid recovery orders between 2000 and 2015, only 2% involved U.S. companies. So, it seems from what she said at the time, there was no deliberate targeting in general using state aid, a state aid tool against U.S. companies. But she did also mention that the commission did become interested in Apple's tax affairs in Ireland after the U.S. Senate Permanent Subcommittee on Investigations brought in Tim Cook, CEO of Apple, to answer questions about Apple's tax practices. So, in that way, you could say that this particular investigation was targeted to a U.S. company because they got inspiration from this very high-profile hearing. And Apple is the most high-profile of these companies that this commission had targeted with state aid investigations and tax rulings. So. Yeah, I guess you would say in this case there was a deliberate, targeting of the U.S. company.
Well, let's focus on the decision now. among the tax lawyers that I know, some people are raising their eyebrows at the reasoning of the decision and wondering if the commission's going to appeal. But the case boils down to one of the parties, the commission, not satisfying their burden of proof. What was all that about?
Okay, so let's just maybe start with what the court did agree with on the did side with the commission on. So the court had rejected some of the elements of Ireland's and Apple's arguments against the commission's legal interpretation approach that it used in its 2016 decision. So, for example, the court said, it was okay for the commission to use the existing corporate tax system in Ireland as a reference framework for evaluating whether illegal state aid existed. And the court also said the commission was correct in using the arm's length principle as part of its analysis to check whether Irish tax authorities had in fact treated Apple's group members differently from standalone companies. And it said it could also rely on the OECD's transfer pricing guidelines to do so. But so while it sort of agreed, it held against against Apple and Ireland on those points and favored the commission. But then the court said the commission misapplied that approach, those approaches, and failed to prove that Ireland gave a selected tax advantage to Apple. Basically, what the court did was reject the commission's what they call exclusion approach, which had really formed the foundation of the commission's 2016 decision. And using that approach, the commission argued that Ireland should have allocated the Apple Group's key assets, which in this case, intellectual property licenses that ASI and AOE held. And as a result, the ASI and AOE's income earned through Apple's sales outside North America and South America to their Irish branches. So the court said that the exclusion approach was out of line with the OECD's profit attribution rules, which Ireland follows. And these principles say that profit should be attributed to a permanent establishment based on functions, assets, and risk. But the court found that, although ASI and AOE's Irish branches did carry out some routine limited risk functions, most of their profits were from attributable IP rights held through a cost-sharing arrangement with Apple. So it was Apple and Cupertino that controlled the IP, not ASI or AOE. Since Ireland doesn't tax non-resident income unless it can be attributed to assets controlled by PE in Ireland, the court basically said the commission's approach was wrong and threw out the 2016 decision. But of course, the commission can still appeal. So, it was pretty much a definitive loss for the commission. They misapplied the rules to the two branches that they were looking at. So that's sort of the basis for the case, I guess, for the decision rather.
You mentioned that the delivery mechanism for the alleged state aid were a couple of advanced rulings that were quite old. One of them went back to the early 90s, 1991. The other one was a bit more recent, at least it was this century, 2007. Those are pretty old and cold rulings, advanced rulings. Would things be different today because of the influence of BEPS Action 5? Because there wasn't a lot of transparency back then. When one EU member state issued an advance ruling, they kept it secret. I mean, if the company who received it wanted to publish it, they could, but nobody would ever do that. Basically, this was a clandestine operation. Other folks, other countries, other tax administrations had no idea what was going on between Apple and Ireland. How would that be different today because of BEPS?
So this is a point that some sources had pointed out to me when I was writing my story. So BEPS Action 5, it's about harmful tax practices and is a BEPS minimum standard, and it provides that framework for automatic exchange of tax rulings among tax administrations. So it's interesting that the General Court decision came this year because it's the 5th anniversary of the BEPS project. So it sort of comes at a crucial point, I guess, in the project's implementation phase. Had Action 5 been implemented in 2013 when the commission started looking into tax rulings, then maybe they wouldn't have used the state aid tool in that way. Maybe they would have used it, they would have applied it to other kinds of structures or other kinds of issues. So this is now that Action 5 is pretty much enforced in a lot of countries. It sort of weakens the EU to use a state aid tool, and makes it more difficult for the commission to use that tool in the way that it has. So I think that Action 5 kind of, had it been part of the tax system back then, we wouldn't have had an Apple case probably, or we would have had an Apple case based on different arguments. So yeah, it's pretty interesting to see the intersection of the BEPS project and this particular case.
Stephanie, let's stick with this BEPS theme and run with it a bit. And I'm thinking here in regards to the so-called BEPS 2.0, the work of the inclusive framework, Pillar 1 and Pillar 2. At one level, that has nothing to do with what's going on with Apple and its state aid, but I can't help but wonder if it somehow provides momentum to put wind in the sails of this global tax reform effort. And here's why. Basically, Apple got away with something here. They were able to achieve stateless income, and they got it legally through very careful tax planning, but they didn't luck into it. I mean, they planned their way into this, where no one is taxing their profits. Not Ireland, which is the host country for these branches, not the United States, which is the resident country of the parent corporation, and where the intellectual property that generated the profits was actually developed. And perhaps most critically, not the market jurisdictions where the sales occurred. So if it's not the residence country, and it's not the host country or the branches, and it's not the market jurisdiction, who's taxing their profits? Well, the answer we see from the court is that nobody's taxing their profits. They got away with stateless income. Isn't that going to help the inclusive framework?
Yeah, I think that's right. So like you said, the Apple decision doesn't necessarily have a direct connection to what the OECD is doing right now on Pillars 1 and 2, but it does focus on the underlying problem, which is that the international tax rules are in desperate need of reform to deal with the modern economy. Since the Apple decision, there have been some major changes in international tax rules. Ireland amended their tax rules to eliminate the use of the double Irish structure, and the US introduced the TCJA, which introduced GILTI, so that ensured that corporations are at least liable on a minimum amount of tax. So yes, so this Apple decision, it reinforces the idea that that reform is needed, and that idea really gained traction during the financial crisis, and will even gain more traction after while governments are dealing with the fallout of the pandemic. So, it does raise the stakes for a global solution to be agreed to update those rules, or else, we'll face a litany of unilateral measures, from within the EU and outside. So that is really putting the pressure on the OECD to lead these countries to agree on Pillars 1 and 2, to agree on rules to amend the profit allocation and nexus rules, and to ensure that corporations pay minimum amount of tax. So the question is, though, is there support, and is there enough support to rally around the solution that's on the table? It's unclear at the moment where the situation is going. It's also unclear whether what's agreed at the OECD will be enough to address the real problems that the Apple decision gets at. So it does have implications for the negotiations. It also raises questions about, now that the Commission is sort of has to run back to the EU with their tail between their legs on this. Will that make them more aggressive in trying to tackle corporate tax avoidance, or will they kind of stand back a little and give room to the OECD to, lead these countries to a common solution? We've always been told that the big worry was the EU would just break off and do their own thing. They have tried a tax digital economy, but that route sort of failed after they failed to to introduce a digital services tax across the block. So it's kind of remains to be seen where the negotiations will go now that that this decision is out.
You can almost sense that there's a bit of a turf war between the OECD and the EU, although that might not be the right term. I also get the sense that the EU would be perfectly happy to go it alone and get some sort of a directive requiring a across-the-board digital services tax for the whole EU bloc, which would be mostly aimed probably at US digital service providers, depending on how the tax is structured. And that conflicts with what the OECD is doing with their collaborative approach. They want to avoid unilateral solutions, and I'm guessing the EU thinks it has a perfectly good unilateral solution at its disposal that it's ready to use anytime it wants. So it'll be interesting to see how those tensions play out between Paris and Brussels. But let me ask you this: get out your crystal ball and respond to this. Is there going to be an appeal? Does the Commission appeal this? Because after all, the court was not the Europe's highest court. There is a chance here for them to take a second bite at the apple, no pun intended. Do we get an appeal?
I feel like the Commission will appeal just to save face, but I don't know. It seems that okay, so the General Court did side with the Commission on some points, like their approach, their legal interpretation approach, and they held against the Commission on a major part of their arguments. So I think that there's going to be an appeal, but I don't know if it's going to be successful. I mean, there is a possibility that the Commission could just scrap everything altogether and start over, using, taking notes from what the General Court said was permissible and what wasn't, and kind of maybe reformulating their approach, but that could take years to do that. So I would think that they would appeal, but I don't know if they'd be successful. I mean, I guess the General Court isn't known to be like a bellwether for what the ECJ will decide. So I am not really sure. What do you think?
Well, I think there'll be an appeal for sure. And as you hinted, I think if the appeal is unsuccessful, they might just start over. And we get into a little bit of a legal nuance here. I hate using Latin on these broadcasts, but there's a term res judicata, which basically means the thing has been decided. And we have that in the Anglo-American legal system. You don't have it in most civil code systems, which is what you have in the European Union here. There is no res judicata as to future remedies being sought by the Commission. So if they lose, they could start from square one. The only limitation is a basic 10-year limitation on how far back they can go retroactively. But because they began this back in 2013, as you said, they could go quite far back all the way and cover the years in question, even though they're not open years for audit. So yeah, I don't think we have seen the end of this dispute by a long shot. I think first there's going to be an appeal, and if it's unsuccessful with there not being any res judicata doctrine, they could just start the whole thing over again. And there's actual legal precedents for that. There's a case, EDF, involving state aid, where all of this happened. They lost, and then they went back and started over again, and eventually won. So Apple might be celebrating now. There may be some smiles in Cupertino, but I'm not sure how long they'll last.
Yeah. I forgot to mention one thing. I mentioned before there was a question about what the Commission will do next besides appeal. I think so. On the day that the General Court released its decision, the Commission released a tax package to ensure fair and simple taxation. It had like 25 measures that the Commission intends to implement in the next 4 years, and like, compared to other packages that the Commission had introduced to kind of address corporate tax evasion and corporate tax avoidance and evasion, tax evasion, this seemed like less aggressive to me. It relied a lot on, codes of conduct and, research and is kind of soft measures, and at the same time trying to show that the Commission is still going after corporate tax avoidance. But it seemed to really give space to the OECD to do its work and to allow countries to kind of come to an agreement on, this corporate tax update. So this is an interesting development because, we talked about how the EU and the OECD sort of had competing interests, or maybe seemed like they're competing with each other rather than cooperating with each other. But this package seems to me more, it seems to indicate to me more that the Commission is willing to work with the OECD rather than against. So I guess that's one point to consider as well.
Well, time will tell. I'm sure the two sides are talking to each other.
Yeah.
Yeah. Stephanie, thank you for joining us. As I say, I don't think we've heard the last of the European Commission versus Apple, so maybe we'll have to do this again after the case goes before the Court of Justice. Thank you for joining us.
Thank you.